How's it going, everybody? Welcome back to another video. Today we're going to talk about maximizing your interest rate reduction. Now, this is a topic that I'd like to discuss quite a bit with my customers because what it does is your interest rate is probably one of the most expensive things that are costing you money every month, especially if you have credit cards that are in high rates. And when I say high rates, I'm talking about 15% or more, and then sometimes it goes even to 20+%. Now, that's a lot of money to put away. And most of us, particularly those situations where customers are just getting started in the credit game, and they're trying to fix it, is because of circumstances that cause them to pay a lot of money, accumulate a lot of interest rates and debts, and essentially try to pay that down. Now, there's a lot of terminologies out there, including velocity banking, among other things, that are actually teaching you on how to pay that down using your own income, how to use your cash flow, and of course, how to work things out so that you can maximize the opportunity to build your wealth. So in this channel, as you guys know, I discuss a lot of different things when it comes to interest, when it comes to credit, when it comes to personal finances, your wealth. And I think the biggest focus right now, and especially if you're in 2019 and trying to put things together in perspective, you're learning from other people's channel, which I greatly respect the fact that you're self-educating yourself and of course trying to build that level of wealth. The biggest thing you need to focus on is looking at your cash flow, looking at what you can do to increase, number one, your income, to realize the financial goals that you want, and of course, really take the time to write it down and specifically analyze what are some of the things in your budget that you can, I wouldn't say cut down or save on, but reduce in terms of quantity. You might want to even think about doing certain things like talking to your credit card companies and discussing potential opportunities for line increases, or to open up a new card that has a lower rate with a balance transfer option internally. There's a lot of different things that can be done, or possibly looking at new cards that offers balance transfers at 0% for several months on end, right? So there's a lot of different things that you can do, and I think the best step to really increasing your cash flow is to prioritize on the element of reducing your interest rate. And the reason I say that is because most of you guys, when you're maxing out your credit cards or you're using your credit cards, you pay your monthly bills, you leverage your credit, you try to increase the limits, and sometimes what ends up happening is during that process, you come across financial circumstances where you have an emergency. Not your fault, right? Like if your car breaks down all of a sudden because you're driving and something happens, you hit a pothole, that's an expense that you don't necessarily have the money for at times because, again, you're self-investing, you're doing certain things. Your work is not the most pleasurable thing, but you're getting those paychecks on a serial basis, which is either bi-weekly, monthly, whatever it is, right? And that's causing you delays in getting paid, which in turn you have to leverage credit. Now, sometimes what happens is there's obligations that come in, like medical conditions, etc., that's going to cost you a little bit more. And at certain times, you can't really go out there and print money on demand, right? So you literally have to use your credit cards or debts that you have, or lines, or loans, whatever you have access to get across that bump, to get across that level. Now, one of the key things I'll tell you guys right now is there are several strategies that you can reduce your interest rates. Now, most of these types of strategies I'm about to teach you will require for you to start opening a dialogue with the credit card company or, revolving line company that you're with. And these dialogues are not necessarily the most pleasing of conversations. And I'll give you two reasons why I say that. First, these dialogues require you to be honest about your financials to that company. You have to disclose to them what you're going through in terms of hardship, and they will require you to go ahead and give them an assessment about where you're at. And the first steps they're going to ask is, now, what exactly is the situation that you're going through? Are you going through some of the financial difficulties in terms of not being able to pay your minimums? What's your income like? What's your net expenses, everything included? How much is coming in? How much going out? What are some of the miscellaneous expenses you have? And what they'll do is they'll factor in a budget for you, and they'll possibly close down your credit card or line of credit or whatever it is and turn it into an installment for a 4-year period with a very low interest rate. So sometimes what ends up happening is, let's say if you have a maxed out $50,000 credit card, you're spending thousands of dollars a month just on the minimum payment and the interest rate. What they will do is probably reduce that amount to, let's say $1,500 to $1,600 a month with a rate of anywhere between 3 to 4% based on your financial circumstances. That's what we call a hardship department. There's a lot of other individuals who are actually gone through that process where they had to shut down several cards within the same bank just to get access to that. So for instance, if you're going through that situation, and let's assume that you have a card with that same company that's open still, and it's very low balance, but you still have a good line of, good open revolving line with them, and you have one card that's maxed out, and you want to go through that department to kind of restructure your financials to get you a lower payment to close that card out and to pay it in an installment period, just to save you money and increase your cash flow, the chances of them shutting down the card that you have open is very high. And they possibly will do that because they want to make sure that you're not actually borrowing from them as well again and causing them some interest reduction, because that's income for them, for financial institutions. So that's a consideration that you have to make when you're going through those type of departments and thinking about that situation. Okay, so that's the first step. So that's called a hardship department. In order to get qualified for that, you'll absolutely need to go through your financials and disclose to them some of the levels of income that you have, the expenses on a detailed basis. They're going to ask you what's a comfortable payment you can make, and if you qualify, they'll fit you in that criteria. Now, I used to run a debt arbitrage business, and one of the things that I've done was educate customers on how to get that qualification in terms of what the amount will be and whether the department will approve them or not. And I increase the likelihood of them getting approved. And unfortunately, I do educate them about the fact that they'll no longer have access to that card, and that's going to hurt them. But the reality is, if you're going to go ahead and reduce that monthly payment and you want to increase your cash flow, you don't want to be carrying more debt. You don't want to be paying more interest. So it's better off that you shut that card down specifically. Now, does it affect your credit? Absolutely it will, right? Because all of a sudden you had a utilization. Of course, it was maxed out, but what's going to end up happening is that history is going to go, right? It's going to be there. You paid it in full, etc., closed by grantor. But what's going to end up happening is that utilization is going to go away, because now it's just an installment loan, right? And now you have to pay it down, and it's got a fixed schedule. Where revolving credit doesn't have a fixed schedule. You can use it, pay it off, and you still be able to play with the utilization, which in turn affects your credit score. But in this scenario, you will not have that utilization anymore. It'll be shut down. You'll have an installment loan, but it won't adversely affect your credit in a way that it's going to be a negative remark. But it removes that chance of utilization for you to ever use it again, right? So that's a consideration you need to make and understand when you're getting into this. So that's one option of really getting lower interest rates. The second option is the balance transfers. A lot of people do that, is they apply for a new card, and that new card usually has a good balance transfer, which is usually 0%. And then they say you have it for a period of like 12 to 16 months. And the way it works is the card that you're applying with usually writes a check to the company that you want to transfer a balance from. And what they would do is, now you have new debt here in this new card, and usually you're paying like 0% for a period of 12 to 16 months or whatever it is, right? So you can take advantage of that. That can work, but this only makes sense if you have a huge enough balance. So for instance, if you have $10,000 or more, it's a good idea. If you have less than that, and the rates are not as significant, I don't think it's worth it, because you're paying a small fee to transfer that balance, and usually it's like around 2.5% to 3%, sometimes even 4%, with some of the private companies out there. So you want to be careful with that. So that's a secondary option of really reducing the rate, because now you're at 0%. So you should take this time to really maximize the payoff, right? To increase your leverage, sacrifice a little bit for the first year or two, pay that balance down as much as you can while you still have that rate going for you, and then try to work around a scenario where you can increase your cash flow, because this gives you a prime opportunity to pay debt at 0%. So most of you guys should be able to do that, and the only cost you have in that process is that 3% balance transfer, or whatever the rate is ongoing during that promotional period, right? So that's a good way of doing it. So again, just to recap, we have the first option, which is the hardship department, which will create a payment plan for you, looking at your financials, your expenses, your income, and going through disclosures of what you can afford or not, to see whether or not you fit into one of their programs and if you qualify. Chances are you might, depending on how you structure your financials. Second option is the balance transfer, which is essentially applying with a new card that has the opportunity to give you a 0% rate for a period of 6, 12, 18 months, whatever it is. And they'll pay the check to the company that you owe originally, and they'll take over the balance, and now you have the opportunity to pay that down completely in the next couple of months, and you should maximize that opportunity. And like I said, it only makes sense if you have a huge enough balance, and typically you want to go for balances that are $10,000 or more. Okay? So that's a good way of going about reducing your interest rate. Now, there's alternative options, but those options require for you to have assets. So let's go over them. The first is, let's say if you have a home, you can use a home equity line of credit. The rates are lower on those. And typically what you would do is you would pay off your unsecured cards, right? And you'd have that revolving jump in, and it'll help you spread out so that you can go out there, and they have specific type of personal loans for debt restructuring. So you can have a loan for 6.25%, 7%, much lower than the 15% that you're paying, and that is an instantaneous leverage for you to get cash flow increase in your scenario. And with that extra cash flow, you can process, paying larger and more, bigger amounts and lump sums towards those original debt obligations that you have. The goal here is always pay the high interest rate first. And I say that is because a lot of people out there, they teach you, okay, if you just pay the smaller one now, you can go to the bigger one. The goal is do as much as you can to pay the high interest rate one down first, or structure it in a way that you can take that out and reduce that rate to almost nothing, which is, in low 5%, or even like 6 or 7%. But this is the way that you're going to go ahead and increase your cash flow, because the more cash you have in your hands, the better it is. The goal of credit and the whole personal financial education is not a question of, can I maintain my minimums and get away with it and do certain things in my life that'll help me increase my leverage. The goal of personal credit is to build your wealth, to use it the right way, structure it, leverage it, get institutional relationships going for yourself that you can actually go out there and build massive wealth, build massive fortunes, okay? So this was a video just to go over some of the options that are available for reducing your interest rate. And just to recap one more time, the payment department, which is the hardship, looks at your financial circumstances or situations. They'll analyze your personal financial cash flow, whether it be income level, your expenses, what ends up happening there, and verifying whether or not you're comfortable with a certain minimum payment and a threshold. They will shut down your card and cards if you have other ones with the same bank, just to ensure that you actually fit in that program and you pay it off. You also have the option of balance transfers, where we talk about you apply with a new credit card company and they will pay a check or write a check to the original debt that you have with the other bank, and they'll carry the balance for you. The transfer is usually between 2.75% to 4% in terms of fee, and this only makes sense if you have a large enough volume of debt, which is usually $10,000 or more. If that be the scenario, then possibly you want to consider that. And the third option we talk about is the alternative strategy, which is if you have assets like a home and you can get a line of credit against it, pay down your debts, and then eventually when your credit score is up again, then go for a reconsolidation loan, right? Like consolidating your debt into a restructuring loan, where you can actually take a loan with a really low interest rate and pay off possibly your line of credit or other credit cards that you still got going on, just to restructure your credit profile to meet certain things that you want to do in the future. Okay, so I hope this video was helpful and you guys got the information that I'm trying to share with you. Once again, don't forget to subscribe if you're new to this channel. Like this video if you felt that whatever I shared with you today was helpful and informative. And leave a comment below about what you learned today. Tell me what some of the situations you guys got going on. I'll be more than happy to answer you. Okay? With that said and done, this is Ali Tarafdar, your guide and mentor. Bye for now.